Hey everyone, Longacres Finance here, and today we will be taking a closer look at the Dividend Kings. The Dividend Kings are a group of select companies that have been increasing their dividend payments for 50 consecutive years. Now that is a very stable, safe, and growing dividend stream. These companies are favored by seasoned dividend investors for exactly those three reasons. In this video, we will go over the Dividend Kings. We will see how they are doing this year, and I'll show you 4 methods of how you can pick the best Dividend Kings right now. If that sounds like something you might like, stay tuned. If you're new to the channel, please hit that like button and make sure to subscribe for more dividend videos. Alright, let's get going. Currently, there are 31 Dividend Kings, according to SureDividend.com. There are other lists of Dividend Kings out there on the web, and some that include more companies. But I like the explanation on SureDividend of why certain companies such as Target and Illinois Toolworks should not be on the list yet. You can head over to their website if you'd like to know more. I'll be using their list of Dividend Kings for my analysis. Through June, the year-to-date return of all 31 Dividend Kings is 13.99%. That's not too shabby for a 6-month return. It is, however, slightly worse than the Dividend Aristocrat's 6-month return of 14.52%. There are a handful of Dividend Kings that are outpacing the average return thus far. The best Dividend King right now is Federal Realty, with a smashing 40.22% return this year. Coming in second place is Cincinnati Financial with a strong 34.98% return. And wrapping up the top 3, we have National Fuel and Gas with a solid 29.29% return. Only 3 out of the 31 Dividend Kings are in the red this year. Colgate-Palmolive is down 3.9%, Procter & Gamble is down 1.82%, and SJW Group is down 7.8%. This means if you randomly invested in any Dividend King this year, the odds that your investment would lose value was less than 10%. Past returns are fun to look at, but I think most investors are more curious what returns we can expect in the future. And that is exactly what we will look at next. Let's jump over to my Dividend King data spreadsheet. I've got a whole bunch of data for each of the 31 Dividend Kings right here. The first method for selecting a Dividend King is a combination of dividend yield and dividend growth. This method was coined by an author on Seeking Alpha as the Chowder Rule. The premise is simple. You add the current dividend yield to the 5-year dividend growth rate. The creator of this approach would look for stocks above a specific number here, but I like to look for the highest Chowder number. I'm also looking to narrow down the list of 31 Dividend Kings to roughly 25%. That means I want to look at the top 8 companies with the best Chowder number. Let's filter for the highest Chowder number, and here we go. Now we are looking at the top 8 companies that have the best combination of dividend yield and dividend growth. The Chowder Rule is very useful because it helps you identify companies that are either paying a high dividend yield right now with modest dividend growth, or companies that are growing their dividend stream very quickly with a lower current dividend yield. And here we have a good blend of both. We have Altria and Universal that offer very strong dividend yields. And we also have Hormel, Lowe's, Nordson, and SJW Group that have double-digit dividend growth histories. Additionally, Stepan and Cisco fall in between. This blend of 8 stocks offers a collective dividend yield of 2.89%, with a historical dividend growth rate of 10.44%. If we look at the year-to-date return of these 8 stocks of 9.4%, it looks worse than the Dividend King average return of 13.99%. But these are the 8 best Chowder companies right now, July of 2021, and they should be evaluated on their returns going forward instead of past performance. I'm going to start tracking how this method performs going forward, and I'll be updating the results here on my channel in the coming months. Let's move on to method number 2, which is the forward earnings per share growth rate. Over long periods of time, there is a correlation between earnings growth and share price growth. Typically, companies that have been able to grow their earnings quickly also saw their share price grow quickly. The growth may not be proportional, but it moves in the same general direction. So method number 2 is to target the Dividend Kings that are expected to have the highest earnings per share growth in the future. Here we will rely on analyst estimates of earnings growth over the next 5 years. Let's turn that filter on and see which Dividend Kings have the highest EPS growth rates. Again, we are looking at the top 8 Dividend Kings, or about 25% of the Dividend King universe of stocks. I can see that all 8 companies have very strong EPS forecasts. Cisco looks like the strongest candidate for earnings growth, with a forecasted 29.37% growth rate. H.B. Fuller also clocks in with a strong 20% growth forecast, and Lowe's is just shy of 20%. The other 5 companies, ABM Industries, Cincinnati Financial, Nordson, Parker Hannifin, and Stanley Black & Decker, also have solid double-digit expected growth rates. These 8 Dividend Kings offer a much lower current dividend yield of 1.58%, with a 7.48% 5-year dividend growth rate. But if the earnings forecasts pan out, we can expect to see both these figures climb in the upcoming months. Taking a look at the year-to-date return for these 8 companies, we have a pretty strong 17.91% gain. That is better than the average return for the Dividend Kings thus far. Similar to the Chowder approach, I will evaluate how well this strategy works going forward. Moving on to method number 3, which is a modification of method 2. Instead of solely looking at forward expected earnings growth rate, I will combine that forecast with the current valuation of each company. Using dividend yield theory to measure current valuation, we can extrapolate the impact of reversion to fair value for each stock and combine that with the forecasted earnings per share growth rate. Let me explain this better using an example. Black Hills Corporation is potentially 9.7% undervalued right now, based on dividend yield theory. If we assume that over the next 5 years, the stock will return to fair valuation, this would mean the stock will increase by 9.7%. And in order to combine this growth with the expected earnings per share growth, we need to figure out the annual growth equivalent to 9.7% growth over 5 years. The formula is quite simple. You add 1 to the percentage and raise that sum to the power of 1 divided by the number of years, which in this case is 5, and subtract 1 from the result. So the 9.7% undervaluation for Black Hills Corporation equates to a 2.02% boost to annual return. Since the undervalue here is presented as a negative percentage, I need to convert it to a positive number when combined with the earnings growth rate. In this method, potentially undervalued companies are given a boost, while overvalued companies are penalized. So let's see which 8 Dividend Kings have the best forecasted earnings growth combined with reversion to fair value. As you can see, we retain 5 of the best companies with forecasted earnings per share growth, and we get 3 additional companies that slide into the 8 here. California Water Service, even though it's potentially overvalued right now, presents a better opportunity going forward based on combined EPS growth and reversion to fair value. SJW and Tootsie Roll are the other 2 companies that place in the top 8 stocks under this method, and both appear to be potentially undervalued right now. These 8 Dividend Kings currently offer an average dividend yield of 1.64%, with a 7.28% dividend growth rate. These 8 companies have thus far returned 12.14% in 2021, so slightly worse than the average Dividend King return. But like the 2 methods before, we will track this method going forward to see if it holds any merit. And finally, method number 4 is to focus on the highest quant-rated stocks. For this, I have used the Wall Street Analyst rating from Seeking Alpha, where 5 is the highest rating and 1 is the lowest rating. Turning on this filter, we can see a total of 9 companies show up here. Emerson Electric and Parker Hannifin both have a current rating of 4.04. I have chosen to use potential valuation as a deciding factor here, and Parker Hannifin wins out because it's less overvalued right now compared to Emerson Electric. As you can see, all of the top 8 stocks here are rated 4 or better, which implies that according to Wall Street analysts, all of these stocks are a buy right now. These 8 Dividend Kings currently offer a dividend yield of 2.03%, with a 6.53% 5-year dividend growth rate. These 8 companies have a year-to-date return of 13.45% in 2021 thus far, which is also slightly worse than the average Dividend King return. Like the prior methods, this one will be evaluated going forward. It'll be interesting to see if any or all of these methods can generate alpha over the Dividend Kings universe going forward. I'm not advocating for anyone to use any of these approaches to investing, but if any method caught your interest, feel free to implement it into your review or investing strategy. An interesting thing to point out here is that there is obviously overlap between the 4 methods we just talked about. Lowe's was the only company that appeared on each of the approaches, and ABM Industries, H.B. Fuller, Parker Hannifin, and Cisco appeared in 3 of the 4 methods. Does that mean these stocks are better than the others? Perhaps, and that is something I intend to track as well. Let me know in the comments below if you liked any of these methods, or if you use a similar method in your stock selection process. Thank you for watching and see you next time.